So 2023, it's risk on. You see this headline here, Veritas, which is a developer in San Francisco, is basically defaulting on a $450 million loan on this particular set of properties, right? So there's risk out there. 2023, I want to go over in this video, what are the 3 greatest risks and things you can do to help prevent any sort of loss, what you should be concerned about in your current deals. This channel is dedicated to helping you make money in real estate and other sorts of investments, as well as strategy for taxes and avoiding any loss. One way to make more is just to make sure that you're not losing or losing money on the back end. So we're gonna talk about the 3 greatest risks, how to evaluate deals, and how to put yourself in the best position to succeed in 2023. Let's do it. Okay, quick disclaimer, I'm not your investment advisor. I'm not giving you any investment advice. These are just my opinions. 2023 real estate risks. Obviously, rates have come up. Rates have gotten higher. Everybody's talking about it. There's a lot of people concerned about it. How do I get into a deal now? How do I even buy a house right now? Because rates have gone from 3% to 8% and kind of hovered around that area. So with higher rates, what it's really doing is this is really shaking out deals that really maybe shouldn't have been done in the first place. Deals that are more speculative. Deals that a lot of times, maybe they were in kind of shaky markets, or they're only assuming that rents were going to go up by 20% per year like they did before. So the highest risk deals that I find, really these are the 3 greatest ones right here, are new construction, Class A deals, which typically new construction is Class A, but a brand new type of deals built within the last 10 years, and really undercapitalized deals. And so that really means, deal operators that did not raise enough money, didn't have enough resources to be able to make things happen. So if something gets in trouble and there's not enough cash there, those deals are in trouble. So the greatest risk that you find in general is always the team. It's always the team running it. It's always the group. Now we're multifamily operators. We run deals like this one behind me here. And it's always basically how conservative were you on the way you underwrote the deal. It also is really, really important that someone on the team has at least 10 or more years of experience, has seen a downturn before, has really, been through things like this before. We really haven't had a significant downturn actually in the last 15 years, really since, it was hard to believe it was 15 years since 2008. And so having somebody in the team who's seen that, who's gone through that, is very, very helpful. And what that allows you to do is someone hopefully that's been in that position can be the voice of reason, can be, hey, we looked at this deal and when we're underwriting, we want to make sure that we're doing it in the best possible way. Also, 2023 is going to be the year of operations. If you can operate things well, then things will function well. It sounds very simple, but Ken McElroy is a friend of mine. He said, this is the year of operations. I recently had him on a panel and he was basically talking about this, that groups that can really work the plan, they will succeed. Now, one example of this is we do a lot of value add deals. We're buying apartment buildings that were built in the 70s, sometimes the 80s, and we're basically going in and putting in $6,000, $10,000 per unit. We're seeing an upside in the rents after we do those renovations. So, being able to do that, as long as we know that we can come in and do the value add, we'll see that upside. We're seeing about a 50% upside in those deals where rent's $1,000, we put $6,000 in, we'll see rents $1,500. I've been quoting that for a while, right? Because it's true, we're seeing that. And if we can renovate 80% of those over a 2 to 3 year period, we know we're gonna be just fine. Because by the time our loan, if we need to refinance or something, we've increased the value. We've done a lot there as far as value. So that's all operations. It's all making sure that we operate in a way that is really, really, efficient, that we can foresee challenges as they come. Everybody wishes they saw challenges before they're wishes they could kind of like predict the future, but you can't. There's no way you really can predict the future. The only thing you can do is try to do the best with what you have, really learn from your mistakes. And even though I've been in some deals where we've had a lot of issues come up, things we learn along the way, right? But experience is really the only thing that really shortcuts that. And that's why I say one person on the team who has lots of experience who said, hey, I've seen this, I've been through this. And we actually just had this happen with a property recently where there was a shooting on the property. This is, these are not like rough properties we're doing, but there was a shooting on one of the properties, and we had to check our insurance and say, hey, did we have assault and there's like assault and battery insurance as operators? that, if we have it there, we're covered if we get sued. But if not, we're not covered. There's a lot of exclusions for that particular thing. Insurance, they're very sneaky on how they have things included or excluded. And we had it for this particular property. So now we're going to go to the other property saying, hey, let's make sure we have this on all our other properties. So in case that happens, we're covered, right? Even if we're paying a little bit more money. So it's just stuff like that to really make sure that we're really doing what's best for our investors. Let's talk about your current passive investments, right? Your current passive investments, particularly your real estate. So number one thing you can do as a passive investor is to have communication with your sponsor. Reach out to your sponsor, the person who's operating the deal. Make sure if you have any questions, hey, how's it going? What's happening? Just make sure you're keeping in touch with sponsors. And if they're not getting back, there may be some reason to be concerned about the property, right? Because sponsors, in my opinion, should be very quick to be able to respond. Now, if they're on vacation or something happens, maybe you can reach somebody else on the team and don't overly read into it. But you should be able to get any questions that you have about the way your deal is being operated. So one question that I like to ask when I'm passively investing in a deal is, how are you mitigating these risks? What are you doing if interest rates rise, even significantly higher? If rates are at 7-8%, what are we doing if rates go way, way higher? How are we gonna walk through that? And so a few ways that we're doing it, we're seeing it, is that sometimes sponsors are withholding distributions. We've had a property or two we've had to do that on just to make sure that we've got enough cash. It's not fun to be able to do that, but we want to make sure. We'd much rather, have a little bit of pain now, or we call it like have some suck now, right? It's just like it kind of sucks a little bit now, but it's a lot less later than having some major issue with the property and not having enough capitalization on the property. So, capital preservation really is number one. There's two things you're doing when you're investing, particularly in multifamily. You're going for capital preservation so that the money you invest is preserved. And then the second thing is that it's capital appreciation, right? You're hoping that that money will go find more dollars and bring it back, and you'll have capital appreciation. So, but number two is really secondary, just making sure we preserve the capital. So any good operator should be doing that. And then the third thing really to look at here is don't count on cash flow in deals, even those that have cash flowed. So meaning if a deal has been cash flowing consistently for the last year or more, don't assume it will continue to cash flow. Some investors say, hey, it's the beginning of the year, I'm calling to check in, or I'm emailing to check in, hey, what's it look like for this deal going forward? Well, that can change. It depends, what the Fed does with interest rates. There's a lot of things that depend. But I would say any multifamily deal right now in general, I would be a little more cautious or just have a much more conservative number as far as how you think that particular deal is going to cash flow. So, likely it will turn out fine. This is going to be for the long term. These deals are going to be great because we're short housing units. We know rent is going to continue to go up, which it has been, especially in the right markets. And so we know this stuff is going to work out well over time. But it's just in the moment of, hey, when this, the interest costs get higher and there's some things getting squeezed a bit, operations is really important. And part of that is cash management, making sure that, we're really making sure that we're operating on an efficient level. And sometimes that does mean holding distributions, which is unfortunate, but it does happen. Like I talked about some of the risky deals, new construction in Class A, those are brand new or close to brand new. There's no value to add, right? There's no margin of safety. Warren Buffett talks about that. The idea of a margin of safety, of being able to come in and say, hey, we know even if this thing doesn't go well, we've got a little bit of margin here. Well, with newer deals, you can't go in and add enough value to really allow that to go up. And new construction is similar to that. It's like we don't know what the market's going to look like in 2 years or a year, and there's no fixed rate construction debt. So you've got to just pay whatever the market allows. So if rates go even higher, then we have to look at that and consider that. So that's something to look at. And then the last one really is if a deal is undercapitalized, if somebody didn't raise enough, they weren't as conservative on the underwriting, something doesn't go as well, just making sure there's enough cash there. So I say there is a positive to all of this though. So if you're sitting there and you're on the sidelines, you're saying, man, I would love to get involved in the deal, but I just don't know, it seems like things are just tough right now. Well, it's a saying, right? I'm going to share, this is our quote for the one, but it's be fearful when others are greedy and be greedy when others are fearful. And that's Warren Buffett, right? So he says that, and really this is going to lead to better opportunities. When conditions are less favorable, you get better terms as a buyer. You can buy better deals. You can just get just an all-around better deal on a property. So that's stuff that is really exciting. So it's good news and bad news, right? The good news is there's more opportunity for the future. The bad news is it may be a little tighter. There may be things that are higher end type of properties or other types of properties that could struggle, right? So I think those are things to consider. and their operational risks for certain deals. We did this great video. This was a panel. We do this once a month, the Brownstone Equity Monthly panel. And it was the 2023 multifamily outlook. Had Ken McElroy, a couple other guys on there. It was awesome. Go ahead and check that out. And then we have this awesome ebook down below. If you haven't downloaded it, it's called How to Use Inflation to Your Advantage. So you can check that in the comments below or in the description below. This is not just multifamily. It's actually other types of assets as well. How can you use debt? How can you use assets to cash flow and basically be able to actually make more money during this time than you could have had you been sitting in cash or had you missed out? So thanks for taking the time to educate yourself. I look forward to seeing you on the next video.